Okay. She paid you to say that, didn't she? Okay. Okay, let's look into leverage buyouts. Okay, so what do you know as leverage buyouts? So today I want to kind of go through overview, high level, how does it work? Tomorrow I want to kind of go through a high level perspective of the Heinz case, just a summary. I think it's interesting, and then we'll start doing some examples on the board and looking at LBOs different ways. What is a leverage buyout? Someone will ask you that. You got it on your resume? Who has it on their resume? You guys are in trouble. Everybody? You all better know this. And I'm sure you do, right? Because you've actually built it. Yeah, you built the leverage buyouts at internship? Okay, don't answer that question. What is a leverage buyout?
It's a way to pay for a transaction for acquisition.
It is an acquisition of a business. And what way?
Like a combination of debt and equity.
Yeah, and what's unique about that combination?
Highly leveraged.
Highly leveraged. So you're using a significant amount of debt, right? It's an acquisition using a significant amount of debt to meet the cost of the acquisition. What's significant? This is going to be a big focus in the Heinz LBO. There is a lot of, you see this big public buyout out there. You see a very aggressive buyout firm coming in there, 3G from where they're from, Brazil or something, coming in to buy it, and people get freaked out. People get freaked out. Yeah. People get freaked out. Are we going to lose our jobs? Like that. So they tried to downplay the idea whether it was a leveraged buyout or not. So when we think about Heinz case tomorrow, I wanted you to think about what makes it a leveraged buyout, what doesn't make it a leveraged buyout. What was one side versus the other side? There were two sides to it, and we're going to come up with a conclusion ourselves. So it's the acquisition of a company using a significant amount of debt to meet the cost of the acquisition. What makes leveraged buyouts? Aside from just an acquisition, it's the amount of leverage. It's also the type of leverage, because the leverage is secured by the assets in the business that you're buying. You're not like a fund saying, all right, I'm going to raise equity, and then I'm also going to borrow debt from Chase to pay for the company. No, you're going to raise a little bit of equity, and you're going to borrow debt against that company. The debt's held the company. Company defaults, the company gets sold, the assets go pay down the debt on the balance of the company. Right? So kind of think about a mortgage. So I liken this to a mortgage in that, let's say we all buy an apartment in Manhattan. We all buy an apartment building in Manhattan, right? And we raise debt against the assets of the building, right? We raise, 80%, let's say, aggressive mortgage, put 20% equity in, and the idea is we will receive and achieve value in this investment from 3 different areas. 3 different value drivers of an LBO will come out of this, right? What are the 3 different areas? 1, yes?
One's operation performance.
Operation improvement. So our operation performance, meaning, let's say we buy the building, we fill it up with people that are willing to rent out the space. The rental income will come in. That's our EBITDA. That's our operation performance. The rental income comes in. That's EBITDA. That's also cash. It'll go down to slowly pay down the mortgage over time. Operation performance. Next.
The amount of leverage you can get.
What about the amount of leverage?
If you can less equity down and more down.
That's
your IRR in the end.
Yep, that's a separate question though. You're right. That's just what would improve leverageability. But in leading the path to exit, it's EBITDA performance, improving EBITDA, right? Number 2, what else? Kind of trick question because the concept it's the cash debt pay down, which kind of goes hand in hand with EBITDA performance, but it's seen as 2 separate drivers. You can improve EBITDA, and you can also generate cash to pay down the debt. So the mortgage building example is a simplistic example, so it kind of goes hand in hand. But in a company, if you were to improve EBITDA, regardless if it impacts cash or not, if you improve EBITDA, even if you sell the company exit at the same multiple that you bought it for, it's a multiple off of EBITDA. EBITDA is growing, so you're hoping that you've sold it for a greater amount. You know what I'm saying? So you bought the company for 10 times EBITDA at $100 million. That's $1 billion, right? And then EBITDA grows from 100 million to 200 million. Now it's $2 billion. Even if you sell it for the same multiple, the improving EBITDA performance means that you can exit it for a higher value. So there's EBITDA growth, and there's cash debt pay down. There's the cash being produced by the business that will pay down the debt. That's the second strategy. Cash debt pay down. Third strategy, exit multiple. a theory called multiple expansion. In the building example, we can assume, let's say, even if we don't have any renters, even if we don't improve the operation of the business, let's say that over 5 years, just because of the general value of the markets improving, we would hope we can sell the building for a higher value. The values are improving, the multiples are improving. Value is determined in companies by market multiples. So we're just assuming that because prices are rising, the market prices are rising, that we'd hope that we can sell the business for a higher multiple expansion. There are 3 strategies to growth in a leveraged buyout. EBITDA improvements, cash debt paydown, multiple expansion. And think about this example. Here, instead of, same LBO, I'm just illustrating, instead of the equity is increasing, but instead of the equity increasing because EBITDA is improving, equity is increasing because we've basically been paying down debt. We're converting cash and debt into equity. The cash being generated by the business over time is paying down the debt, and because we're paying down the debt, the total value of the business doesn't decrease, the value of the business stays. We're converting debt into equity. So my point is, the way an investor would look at a transaction is they'd hope to see value twofold. 1, equity value increasing by 10 because of organic growth. 2, the value increasing by an additional 10 from the debt being paid down. And so at the end, you'd have a large return from these 2 perspectives. Here's another way of looking at LBOs. What makes a good LBO candidate?
Low debt.
Low debt coming into it. Yeah. You don't want a company that's already highly leveraged. What else? High, steady, predictable cash flows. Very important. Yeah, good. What else? What are other components of a good buyout? Low interest rate, right? Low interest rates, low debt, absolutely. Good debt profile. What else?
Stable market position, brand, strong brand.
Company whose brand and market position would increase over time. Absolutely. The opportunity for multiple expansion. Yes, absolutely. Companies that are in markets that are growing, so you can achieve and see that multiple expansion. Yes. What else?
Strong management.
Well, or maybe weak management. You can turn it around, right? Which leads you to what? Larger picture, larger issue.
EBITDA growth.
Opportunity for EBITDA growth. Opportunity for synergies. There might be something weak in the management. This is where funds come in. Funds that try to specialize in a specific area. A fund that specializes in energy, for example, you would think that they would have managing directors that have expertise in energy and can identify weak management and do things to improve, right? So you're looking for opportunities. So you can find an opportunity in the ability to cut costs. You can find an opportunity in maybe weak management, right? Underutilized equipment, underutilized assets. Absolutely. Anywhere where you can find the capabilities of achieving EBITDA growth, right? So it's all leading to what are consistently components of companies that would achieve EBITDA growth, market growth, high steady cash, right? They're all companies that make good leverage buyouts. Any questions about that? We'll slowly get into more leverage buyout components from a subjective standpoint in time. Let's go into the process of it. How do you do an LBO? That'll give you a good perspective and highlight more the benefits of an LBO. 3 steps to an LBO. You might relate this to 3 steps to an M&A. Same major 3 steps. 1, you have to find the purchase price. You always got to find the purchase price. We spoke about this, getting the purchase price. We'll talk about it again. Sources and uses, and then the adjustments and analysis. In any transaction, you got to start with the purchase price. You have to value it. The last case study we'll do is an LBO, and you have to figure out what the purchase price is. So you have to build a model that leads you to a DCF valuation. And the trick is, because you have limited time, is how do you build a model that gets you to value the entity and then layer on top of it a leveraged buyout model without building two models, because you won't have time to build two models. So you have to build a model with the DCF and have the foresight to be able to say, well, now I got to go back and add the specific rows to convert this operating model into an LBO model and not have it interfere with the DCF analysis. So that's a good kind of challenge. And that's a good model to have. Purchase price calculation leading to pro forma adjustments. So we will do that. We talked about the purchase price. Now we're going to be building off of EBITDA. Remember what we said is the sources and uses would be dependent on the nature of our purchase price, right? So we'll do a valuation analysis to figure out the purchase price. And the sources and uses help us determine how we're going to pay for this entity. What am I paying for? Obviously the purchase price and the possibility of retiring the existing debt, right? How do we know if we have to refinance the existing debt? What do we look for? What's the first thing we look for? Under what situation? If the company is public or private. If the company is public, right? So think about the framework. Public or private. If the company is public, who is responsible for the debt? Always. Not the share. The acquirer. The owner. Not the public shareholders. The acquirer holds responsibility for the debt. And they have to determine whether they need to pay down that debt or if they can keep it on the balance sheet and roll it up with theirs. And obviously for Office Max, they kept it on the balance sheet, they rolled it up. How do you determine that, Daniel? The covenants. And the covenants, you'd look through the covenants, you do diligence on the debt to determine if those covenants state, sometimes covenants will state, if there's a major loan that's being granted, if there's a major company event, like a change in control or a bankruptcy, we want to get paid back. So if the acquirer reads those covenants, and they have to know to be prepared to raise additional funds to pay down those debts. Very simple. If it's a private company, who maintains responsibility for the debt? Say again? Maybe. It depends. The buyer or the seller. The seller can be, as long as they're not a public shareholder. But you negotiate with the seller. Right? And how do we as analysts determine? What are ways to help us determine whether we need to pay down the net debt or not, or whether the net debt is part of the equation or not?
Is that being in the purchase price?
In the purchase price. It's baked into the purchase price. How?
Well, I guess if we're going to the debt,
And how do we determine that?
because that's not part of the structure of the deal, whether we just keep the debt or not.
Yeah, but how? But specifically, there's a way to tell.
Whether or not we have to raise more funds to pay for that debt.
And how do we know that? What determines that? What part of the purchase price? What about the purchase price?
Above the equity purchase price.
Yes. What do you mean?
You add the net debt.
Yes, and how do you know if you add the net debt?
By looking at the actual case, or if you're doing the deal.
Yeah, and what about the deal that you're doing?
I was gonna say, you're looking for goodwill.
No. Say what, John?
It's gonna look, it's gonna be negotiated, so they're gonna say.
Yeah, and how do we know as analysts based on the negotiations? What's that, Heather? Oh, okay.
When you look at the annual report or whatever.
You would. And what else would you look at? AJ gave up. He's done. He's done with this nonsense. He's out of here. That you could look at that too, and the way it's valued. The answer we're looking for, folks, is valuation. Right, the multiple. Right? Yeah.
No.
Yeah. You know what I mean? No, you don't know what I mean. The EBITDA multiple.
Would be higher if you're buying the debt.
No, it would just be there, right? If your purchase price is based on the EBITDA multiple,
Yes.
then that means that your purchase price is an enterprise value. It includes the value of net debt.
So it's, you can see whether the net debt's included or not.
Yes, you can see whether the net debt's included or not based on the valuation, based on the valuation multiple. And it's a word of caution because I see a lot of analysts building purchase price off of EBITDA multiple. That's your purchase price, and then you're adding net debt on top of that. You're double counting net debt. If your purchase price is based on enterprise value, that assumes that you are including net debt into that equation. Don't double count that. And they'll try to throw you off in cases based on that. So it's all about the purchase price. In these cases, the purchase price is based on a public market value stock price. If it's based on a stock price, that's an equity value. In LBOs, we often value things based on a multiple of EBITDA. That's purchase price. That means a purchase price is enterprise value that already includes the assumption of net debt. Don't double count it. You had a question.
So does that mean the multiple?
No, they use enterprise value, but you just have to be careful to note that that already includes net debt. Do not double count it. So if I were to pay, company has 100,000 in EBITDA, I pay 10 times multiple. I'm paying $1 million. I give the seller $1 million. I'm telling him, you deal with the debt. Right? Don't go to the sources, put in $1 million, and add the debt on top of that. You're wrong. You're double counting. Okay?
So in a case, could it be a different case, like let's say you based your purchase price based off, let's say, multiple of sales, and then you would include that net debt?
Yeah. If your multiple is a PE multiple, if it was based on PE, then you would add net debt on top of that. Yep, good. Sources, where's the money coming from? Like M&A, some combination of debt equity. Unlike M&A, we have a structure to it. Where often you'd start with a certain percentage of bank debt. Around 30 or 50% is what's been done on average of bank debt. Bank debt, straight up loan from Chase Bank. Expected returns, 5-12%. Those expected returns are what? Based on what? Saying what? Interest rate. 12% in like 2009, 2010. Then a little bit lower, 5%. Kind of getting back to normal. Lowest risk has initial rights on the assets. The debt is backed against the assets. Key sign to a leveraged buyout is the type of debt that you're raising. What's securing that debt?
So in that case, let's say, for example, that's what we tell it's buyout without just a merger.
Yes. Significant amount of debt and the nature of the debt. Yep. Absolutely. High yield. Junk bonds. 0 to 10%, right? The high yield debt industry is kind of in flux, kind of trying to come back, kind of didn't come back, kind of trying again. What happened to high yield? Oh, that's an interesting question.
Died in the 80s?
Well, it kind of flourished at some point in the 80s, died when the market crashed in 87, right? Who started it? Yeah. Milken and what'd you say? Well, they did mortgage-backed securities. They did a lot of high yield as well. Salomon Brothers. And then it came back up into the early 2000s. And then it kind of died and never really came back again. Why? What happened in the early 2000s? Good piece of history. After the tech bubble. Almost like a year after. Kind of technology related. Good to know. Killed the junk bonds.
Pets.com.
What did you say?
Pets.com.
No. Didn't they IPO recently? Petco. There's everything.com. There's a .com banking group in Morgan Stanley.
The only thing I can think about in 2001, 2002 is the Argentine default. I can't think of anything.
No, but that was something else. But yeah, something else kind of tech related.
In 2001?
2000, I think it actually was 2003. Maybe 2001. I got to double check.
2003?
Between 2001 and 2003. 2002. Let's average it. What else? Something else.
Oh, Enron, WorldCom?
What about WorldCom? Enron had issues, but that's kind of all energy market trading. That didn't affect the junk bond markets as big as, what about WorldCom? You said WorldCom?
Yes.
What about WorldCom?
Went under.
Why though? But then WorldCom didn't bring down the junk bond market, but you're in the right industry.
Wasn't there some type of shoddy accounting?
Okay, yeah, maybe, but it's not about the WorldCom per se, but we're in the right industry.
That's all I know.
That's all you know.
Yeah.
What industry was WorldCom in?
It's Tyco, right?
I think about Tyco.
What about telecom?
Telecom. What about telecom? There's no telecom anymore, right? What about telecom? There's telecom groups. Tech Media Telecom. Well, there's still TMT, right?
Yeah.
Tech Media Telecom, but the T, there's no telecom. What is telecom? What happened to telecom?
Consolidation?
With what? Kind of got swallowed up.
Yes.
What about telecom killed the junk bond market? For you guys, you don't know? You should know. Why did it kill the junk bond market? There were telephones. Nobody had cell phones. Well, some people had cell phones in 2001, but not like they are now, right? You had beepers. We had beepers at Morgan Stanley. Then they started to get to two-way pagers, just as annoying. Right now? Back then, all the analysts had them. No, I don't know. I don't remember if they did that. I think by then we had like Palm Pilots. Yeah, you gotta just charge them up. Kind of useless. Oh, let me go back to my desk to get my email, you know? But back then, the infrastructure for telecom was what? Do you know?
Wasn't it landlines?
You would tell me you guys were like in grammar school back then.
No, was it?
Really?
Yeah.
What happened? Thanks just for rubbing that in. Yeah, there's a generation gap here.
Well, didn't it go a lot from there? We go from landlines to
Yes.
analog to digital?
Kinda. Fiber optics were big. And all the
Nortel was big.
Nortel, all the big power companies were digging up in Manhattan, for example, Con Edison, digging up Con Edison wires under the ground to put in fiber optics. That was the next type of technology. High-speed internet was what was being touted. High-speed internet, put your phone in, boom, get email high speed, right? And there were large hedge funds that were investing billions of dollars in fiber optic cables, solely focused on fiber optic cables. It was the best thing because it's infrastructure, it's capitalized, everyone's going to be into it, everyone's going to be investing in it. It's project finance, it's capitalized project finance, and they charge 20-25% interest, junk bonds, people investing a lot of money. What happened to fiber optic cables? Yeah, well, I mean, kind of cellular technology, Wi-Fi came in. People didn't predict that for some reason. And that was the trend. So I think I remember sitting at a meeting because I was out in the energy group, and they said of all this was like 3 years later, like 2004, of all the fiber optic cables that they put in under the ground, about 10% are being used. Wow. And so now that's coming back because there's a lot of high frequency trading that actually needs those fiber optics. But it's not, once that realization happened where these funds weren't going to get their returns, they imploded, and this was news. Funds imploded, and they lost all that money. But a good piece of history. Fiber optics killed it. Just a lack of foresight in the technology. Right? The advancement of Wi-Fi. Wi-Fi cellular was shoddy. They thought the satellites are a lot more costly, easier just to dig up the ground. They already have wires and lines for telephone lines. Just add fiber optic wires. Seemed like more reasonable. But it didn't work that way.
When I was working as an engineer, we did a lot of fiber optics in remote areas where you can't connect, start to get up there. So you just dig along the lines, lay the cables.
Right.
And that means you connect the Wi-Fi.
And a lot of times they have that infrastructure in place because you got piping and wires and everything underneath for cable or whatever, and you're just kind of feeding wires through. So it made a lot of sense. And it was capitalized. So they thought, okay. And, from a long-term perspective, yes, they would probably recoup that at some point. but it's going to take longer than usual. So junk bonds never resurfaced. There is a type of junk bond out there now. I mean, there's still junk bonds are kind of coming back. More popular in the form of paid-in-kind securities. You guys know paid-in-kind securities? We will model them out. What's a paid-in-kind security? Anyone know?
Is that where the interest is added on to the principal?
It's a security where interest is paid not in cash but in kind, meaning when interest payments come in, it just increases your debt balance. You're basically increasing your debt balance, and then there's interest on interest. So it's quite costly, but it's popular. And so important for everyone to know how to model a paid-in-kind security. If you say you can model it, I don't know if people think it's, wow, the most advanced thing. It's not really that complicated. But we'll model it, and there's tricks to it because is that paid-in-kind interest tax deductible or not? We'll put a switch in if it's tax deductible or not. What are the flows? Important to talk through. Okay, so rarely used, right? Mezzanine more common. Mezzanine, any type of hybrid between debt and equity. So people ask, well, what is mezzanine? It's a convertible bond. There are hundreds of thousands of different types of mezzanine bonds out there, right? Mezzanine, there are convertible debt markets groups and investment banks whose job is to create some sort of any type of structure that would match a particular company's needs with a particular investor that would want to invest in that type of security. It is a blend of debt and equity. It is, in its simplest form, debt with some warrants attached to it. Or, equity with some debt security to it. So we'll model out some forms of mezzanine. It is basically debt that after a certain time or certain hurdles will be converted into equity. So if you were an investor investing in the debt, you can say, okay, well, I can it's debt, so I'm getting interest payments. If the company fails, I'll get the money back after 4 or 5 years. But if the company takes off, I have the upside. I can convert it into equity. That's the benefit. For a company, it is these areas, these high-yield mezzanine areas, which allows leveraged buyouts to happen. This is getting over the threshold of normal debt environment into aggressive buyout lending. How is this possible in an LBO? What an awkward question. Right? This is possible because they are tapping into aggressive types of securities that the public markets just would never allow. You can't do this in the public market environment. You can't say we're going to buy a company, and this company we're going to put 75% down on the business. We're going to get into this aggressive mezzanine lending. We're going to get into high yield bonds. People are going to sell your stock. They're not going to want that. They're not going to want to deal with that. That's why taking the company private, holding onto it for 5 years, improving the operations on your own, then bringing it back out to the market once all this is paid down is the way it works. And it works if you do it right. Okay? Then the rest is equity. Oh, so mezzanine, average return of 13 to 25%. Equity, no downside protection, but you get the most return, AJ, yes?
What's the average IRR on an LBO?
25%.
25?
Well, yes. Hands down, funds say they will not do a deal that's less than 25%. But in reality, it's been like 10, 15%.
More than 5 years.
15, 25? Yeah.
More than 5 years.
Yeah. Over 5 years. But they say we won't want to do a deal that's not less than 25%. So what I used to look at is if the deal is based on average projection of 25%, that's great. At 0% growth, if it's 10 to 15%, meaning that's my floor, then it's a good deal. That's the way we'd look at it. So you're at least getting 10%. So we'll talk about that. Good question.
But if you're getting 10% over 5 years, then wouldn't you just better off just putting that on the market?
Yeah, but I mean that's like the negative scenario. Right. So my negative scenario can't be 0% return. My negative scenario has to be at least 10%. So you're right, better off putting it in the market. But I'm hoping on the fact that I'm getting that 25% upside potential. I'm thinking of it like a mezzanine lender would. A little bit of risk, a little bit of return. Good point. Okay. Take a break. I want to go through high level the analysis, how it works, go through some examples, take it from there. And now the next step is to figure out what the result is, right? The purpose of the leveraged buyout analysis is to determine if we were to buy this business and invest in it and hold it for 5 years and then sell it, what would be the return on our equity? So how do we go through that analysis? I'll give you high-level steps and then we'll go through it again. So, just again, step 1 is to figure out the purchase price. Step 2 is sources and uses. Uses of cash is purchase price, then the net debt, then the fees. Sources is some combination of debt and equity, where the debt is broken out into a lot of tiers, right? So this is how much you're paying for the business, but in general, uses determine what are we funding in total. It's more than just the purchase price, right? It's the purchase price, it's paying the target net debt, it's fees. Right? How are we sourcing this? Some combination of debt and equity. Right? Now, how do we determine our answer? Our answer is, in a leveraged buyout analysis, what is the return on the equity that's being put into the business? What is our return on equity? And how do we determine that? Well, there's a couple things we need to do. Number 1, we need to sell the business. We need to figure out an exit. Okay? So, in order to figure out an exit, we need to project out our EBITDA. Right? So, really the next step, okay, is to build an unlevered free cash flow. Project unlevered free cash flow. I should have put project. Project unlevered free cash flow. We have to project unlevered free cash flow out 5 years or 7 years, however long to run the analysis for, however long we want to build out the analysis for, right? That's the next best first step, because that would give us a projected EBITDA that we can use to calculate our exit. It'll also give us projected cash. We're going to need projected cash. Okay? So we'll project out unlevered free cash flow, and then we're going to calculate our exit. And our exit is going to be simply, let's say, year 5 EBITDA times some exit multiple. And the first question is, how do we determine what our exit multiple is?
What do you buy it for?
We conservatively assume that the exit multiple will be our entry multiple. So we'll take the purchase multiple, we'll apply that. So if we paid 5 times EBITDA for the business, we'll conservatively assume that we'll sell it for 5 times EBITDA. That's conservative because although it's the same multiple, the idea is that hopefully EBITDA has grown. So if EBITDA has grown, we're actually getting a higher value because we're selling for the same multiple. EBITDA's grown, so no multiple expansion. That's our exit. But that's not our return. That's not the money that we get. Why? This is enterprise value. Remember, enterprise value includes that we need to subtract out the net debt to get from exit enterprise value to equity value. We need to calculate and figure out final debt. How do we calculate final debt? Well, there's a few steps to it. We have our starting debt, debt that we raised. We need to calculate the interest incurred on that debt. So 2 things are happening with our debt. We start by raising this debt. Over 5 years, we've incurred interest on that debt each year, right? And also, we've generated cash that will pay down as much debt as we can. That's gonna help us figure out our final debt. It's the debt plus the interest incurred after we've paid down as much as we can. So we got to calculate total interest, which is equal to the debt times the interest rate times 1 minus tax rate times the number of years. So if you think about that, it's just debt times the interest. It's the interest rate incurred, right? But interest is tax deductible. So it's the after-tax interest rate times the number of years that you're incurring that debt. The debt's outstanding for 5 years, you got to multiply it by 5. That's the total interest. The total interest incurred.
Do we assume that some of that principal is going to get paid down?
Yeah.
As we go through.
Yeah, that's what's going to happen now. So now, part 2, we have the sum of the unlevered free cash flow. We have the debt plus total interest. These are our total obligations. This is everything that we owe after 5 years. The debt plus the interest incurred. Minus the sum of each year's unlevered free cash flow. This is the cash generated to pay down our interest and principal. We're paying down as much as we can. That's what that means. That's the final debt. And so, in D, our exit, our return, is our exit minus final debt. That's the money we get back. It's that simple. That's the money we get back. Okay. And so the IRR is the return, the money we got back. How much money did we put in? Huh? Equity that we put in to the power of 1 over the years minus 1. It's a leveraged buyout. That's it. So really, once you get the purchase price and the sources and uses, a couple things you have to do. Make simple cash flow projections, as simple as possible. Why? Because this will give you the final EBITDA and the sum of the cash being generated. The final EBITDA would get us our exit. All you got to do is multiply the final EBITDA by multiple. That's your exit. That's simple. But then you got to calculate final debt. That's the tricky part. It's calculating the final debt, which once you've raised the debt 5 years later, you would have incurred interest. So what's the interest on that debt? The debt times the interest rate times the number of years times 1 minus tax rate. And then we've generated cash to pay down as much of that as we can. So after all that's paid down, we get our final debt. So our exit minus our final debt, that's how much money we put in our pocket. Yes.
So when a PE fund buys out a target, what's a typical debt instrument that they would use? Would they use like a line of credit, or would they use like a 5-year loan, or what's like the typical?
The whole spectrum we're talking about, right? 30-50% bank debt.
Right, but what type of credit would it be?
Oh, we have a bank debt?
Or do like a line of credit, or I guess maybe more granular on the details.
They would start with secured, a term A. If they have the ability to get a term B, they'd get a term B, and they'd always try to get a revolver.
Yeah.
So we'll look at that granularity in the model. Yeah, but good point. Yep. So in a majority of the buyouts, always term A loan, secured, senior secured. If they have the ability and the credit to evolve into a term B, they'd go for a term B, and they'd always try to go for a revolver, a very small revolving line of credit. So let's look at an example together. So let's say we are collectively trying to invest in a business. We've raised a fund, and we've identified, let's say, a distribution business, a distribution company. And we want to know how profitable it can be after 5 years. This business. We want to know our IRR, right? So we first note some financials. Well, I guess my question is, how do we figure out what the IRR is? What's the first thing we would do?
How much are we putting in? How much equity are we putting in?
Okay. Before that, we need to know something before that. Purchase price. So the purchase price. So let's say we're paying $6,500 purchase price. Okay. Now what?
How much of that is equity?
That's all equity. Oh, what do you mean, like sources?
So, okay, so that's just all equity, but do we know the total amount that we're actually gonna put down?
What?
So the debt component.
Not yet.
All right, so I see what you're doing.
What else do you need to know?
For liabilities,
The liability is being raised. That's the next step. But what's one step before that? What about net debt?
Does it have any debt at one time?
Yes, they have 1,000 in net debt. What else? This is M&A stuff. You should know all this. No fees. Now what? What are the total uses? No synergies. What are the total uses? How do you know you're not double counting?
We don't know.
You don't know.
what's the purchase price based on?
Let's say it's based off of a PE multiple.
Then you include.
That's right. But you gotta ask where the purchase price is coming from. Okay. Now we get to liability, right? For simplicity for this example, let's say we're doing 70% debt, 30% equity. Okay? So what's 30% equity? $2,250. Okay. And then $3,750 debt, right? So that's, what did I say? 30% equity, 70% debt. Okay? Got it? Or you don't got it?
How did you get 3750?
Yeah.
Are you getting 30% off the, just PP?
It should be after total uses, right?
Oh, 5250, right? What did I do? 5250, right? Sorry. Okay. I did the typed it in wrong.
Do we have interest rate for debt, tax rate?
We do. We're gonna assume that let's assume that it's 9%. But what's the next step then? Good. Project free cash flow. Okay. So I'm gonna jot down some simple things to project free cash flow. How do we build to it? You guys know how to build to it? What do you need to know? EBITDA, let's say, is 1,000. That's a year zero. I give you year zero numbers. 10%. So we'll put this one together, okay? 1,100, leading us all the way to year 5, 1611. All right, we're doing this one together so I can show you the process. What else do you need to know?
Depreciation, amortization.
DNA, what else?
Capital taxes.
CapEx,
Deferred taxes.
deferred tax, change working capital, taxes on EBIT. So let's just, for the sake of this example, so I can show you the process, unlevered free cash flow, real simple, had come out to be 485 in year one, 485, all the way out to 817. Okay. You just need those. You're really building to these pieces, right? Just make sure you recognize that for now. Okay. Now what?
Can you just tell me about the years?
The sum of all the years, right? And the sum of all the years of cash flows happen to be 3215. Sum of the cash flows.
Now you can find the multiple.
Okay. You can tell me the multiple, right? What's the multiple?
Yeah, you gave us the PE. What did you say? Oh, no, when we started, okay. Yeah, you-
So what's the multiple?
It is 7.5 times.
Yeah. Right? Purchase price plus net debt is enterprise value divided by EBITDA. 7.5 is the multiple. So our exit is 1611 times 7.5. That's our exit. Okay?
So is it normal to find a purchase price based on one multiple of PE and then have the exit based on another?
Yeah.
Is it correct?
You want an EBITDA exit? Could be. Sure. So, our exit is 11,842.
Oh, we should try to split that.
I mean, it's actually, rounding is going to change it a little bit. So 1611 times 7.5, 120825. Yeah? Exit is 120825. Okay? Got it? Now what?
We have to know the debt we have to pay off.
Yeah, how do we know that?
Well, we have the number of years.
You have your debt,
We don't have a tax rate though.
you need a tax rate. Yeah.
I think we used 35%. Okay, what else do you need?
So that's what
You have the interest rate, Paul, we gave it to.
it's 9%.
Yep, 9%. Okay, but just tell me how you're doing it, so everyone can know.
So the debt is 5250
So you want 5250, yeah?
times 9%.
Times 9%, so 5250. Debt times interest rate
Times 1 minus 4.
times 1 minus 35%
Yeah. Times 5.
times 5 years. That's the interest incurred. So we first want to calculate the interest. So how much interest is that? 5250 times 9% times 5 times 0.65. 1535, 65, right? Right? That's the interest. What's that, Tosin? What else?
Now I can find the final debt.
Yeah.
Now the final debt. How do you get the final debt?
So it's the debt, it's 5250 minus the million, so 39.
So it's the 5250
Minus-
plus the interest incurred. These are the total obligations minus the cash, 3215. Right? So we got the 250 plus 1535625 minus 3215. So we're left with 3570.625 in final debt. So we started with 5250, but we also had to pay interest. So with the cash being generated, we're ending with a principal balance of 3570.
So is that minus one off the total number, or is it just off the one over the number you used?
Total number.
Total number.
So what does that mean for our return? How much money do we get? It's the exit, the 12082.5, minus the debt that we're left with, which is the 3576.25. That gives us 8511875. That's what we're left with. Okay. I have this in the slides, in the next pages you're following the slides. It's the same example, but there's a little bit of a rounding difference. In the slides, they had a 7.4 multiple. I used 7.5. So we're doing it on the board. There's a slight difference. But it's the same general idea. You can go back and check it.
Yeah.
Yes, we get a K here. It's a K.
What does this mean for returns? So it's the return. How much money are we putting in?
667.
2250.
Oh, we said.
8511. Common mistake. Divided by 2250. This is basically CAGR, right? IRRs are CAGR. So 8511 divided by 2250 is 3. I gotta get the scientific guy right. 3782. That doesn't do that. Only half does that. 3.72 to the power of 0.25, right?
Yeah.
Okay, 1.39. So it's 39.46%. Pretty good. Right?
The power of 1.25, is it, you do 4 or 5 years there? The power of
What did I do?
2. The power of 0.2.
Yeah, I did 1.25. Huh?
So you get 30 and a half.
Sorry. I did a 4 year, right? So 8511.875 divided by 2250 to the power of 1.2.
0.
30.49. 30.49%. Okay, still good. That's how you do a leverage buyout. And we'll do a lot more examples like this. This is the idea behind the leverage buyout exam. It'll be like this is the paper analysis. What are the major variables? In order to help extrapolate this into what will be a case study later. Simplified 5 in M&A. There's more. What are the major variables? What are the drivers?
Purchase price.
Yes, start with purchase price. Good. Purchase price. 2, target net debt, whether we have to pay it down or not, would have an impact. What else? Good, you're going in order so far.
Probably the multiple, exit multiple.
No.
Fees?
Fees. Thank you. These are minor items. That's fine. Yeah, I know, but even with that on the board, you guys usually, not you guys. Who else? Yes. Sources. Which is the debt raised, and what else? Well, before that, debt raised and nope. Interest. Okay, what else? What else drives the IRR?
And then this would get into multiple, right?
Not until exit, right?
But we're looking now at the actual EBITDA.
Yes. So what? What impacts that? Time frame, yes. What else? EBITDA growth, yes. You're thinking about drivers of unlevered free cash flow. And all that other stuff. Getting to, I'll just summarize as unlevered free cash flow building. Okay. And then what? Now we can get to
Your exit price.
exit multiple. Yes, fine. Okay. So there are assumptions based on the input, right? Purchase, financing. There are assumptions based on the, I'll call it asset management, right? Managing the asset to exit. And there are assumptions based on exit. These are the 3 categories of assumptions. And you have to think about these in relation to the stage the transaction's at. So when you're building a model, the most important variables come: how much am I paying for this? Do I have to pay down that debt? Are there fees related to this? How much debt can I get and at what interest rate? Those are the big variables. So in a simple model, when you're building LBO, usually you're putting together a sensitivity analysis around debt equity ratio and purchase price, purchase multiple. And that's usually the biggest variables. As time goes on, as you do diligence, as you get to know more about the deal, and as you get to negotiate a purchase price, you're negotiating with the lenders, the debt becomes fixed, these items become fixed. The next big variable is managing the asset to exit. Am I achieving? What's my time frame? Can I, in 5 years, achieve my EBITDA growth percentage? If your model converts from an LBO assumptions model to an actual operating model. A lot of times in a PE fund, you're trying to focus more on the operations side. How much cash am I producing from the business? Can I improve that? How am I paying down my debt? This is the next stage. And then finally, what's the biggest variable always is exit. When would I find a buyer? What would he be willing to pay? So in the models that we build, we usually have a model that's variable by exit multiple and exit year. If a buyer comes in 2013 and he'll pay, sorry, what were you doing this? If a buyer comes in 2017, that was weird, and pays, 8 times multiple, would it be worth paying? should we adjust accordingly, right? So we never know when we find an exit and at what price. Exit multiple and year. So we'll figure out how to build a model that's variable by those items. These are the categories of variables. So when running this analysis in these three, when thinking about variables and looking at case studies, these are the three areas we should be thinking about.